All right, listeners, ready to dive deep with us today? We are tackling a topic that's all over your charts, but maybe you don't really see it yet. Support and resistance.
These are really the key levels on a chart once you start to understand these. It's like seeing the matrix.
You're seeing the code, and every trader wants to crack that code right.
Absolutely, because if you can identify these levels, you can get a sense for where the price is going to go next. Maybe even get ahead of it.
And who doesn't want to be ahead of the market? So let's break it down starting with the basics. What are support and resistance in the simplest terms?
Okay, so imagine this. Support's like the floor.
Okay.
Buyers step in. They love a bargain. So at a certain price, enough buyers jump in and they stop the price from falling further.
They swoop in, right?
Exactly. And then resistance is the opposite. It's the ceiling. That's where the sellers come in. They're ready to cash in on their gains, so that flood of supply prevents the price from going up any further.
Okay, I like that visual, the floor and the ceiling. But this is where it gets interesting, for me at least. Our source for this deep dive says that support and resistance, it kind of hinges on psychology.
Yeah, it's true. If you think about it, if everyone acted completely rationally, support and resistance wouldn't work.
It's a self-fulfilling prophecy in a way.
It is. It really is. Because traders, we're all looking for patterns. We're trying to make sense of this chaotic world of the market.
Right.
And so when we see that a stock has bounced off a certain price before we remember that, and the more times it happens, the stronger that level becomes.
It's like everyone's saying, wait a minute, I've seen this before.
Right. It's like a self-fulfilling prophecy because the more people believe in it, the more likely it is to happen again.
So how do we find these magical levels?
Well, our source breaks it down into three main methods that you can use to spot these levels. Trend lines, round numbers, and moving averages.
Trend lines, I kind of get. You're connecting the dots as the price goes up or down. But round numbers always seemed kind of weird to me. Like, does the market really care about hitting $50 versus $49.95?
It's not so much that the market cares, it's more about us.
Us.
Yeah, it's about our brains. Round numbers act as these psychological anchors. They're easier for us to remember and process.
You're clean.
Exactly. So because of that, they become these self-fulfilling prophecies because everyone's watching them.
So you're saying those round numbers become more significant because we make them significant?
Yeah, precisely. Our brains crave simplicity and patterns, so those round numbers become natural focal points for us. Even if it's just a couple of cents difference, it feels more significant.
So it's like everyone's piling on at these round numbers because they think everyone else is watching them too.
Exactly. It becomes this self-reinforcing cycle, and that's why those levels become even more important for traders to watch.
Okay, so we've got trend lines, we've got round numbers. What about those moving averages? Those always seemed a bit more like you need a degree in rocket science to figure out.
They sound intimidating, but they're really not as complicated as they seem. Imagine drawing a line through the middle of a price chart. But here's the thing, that line moves as new price data comes in. That's your moving average.
So it's like a constantly updating average of where the price has been.
Exactly. It helps to smooth out the day-to-day fluctuations and gives you a clear picture of the overall trend.
So if a stock breaks above its moving average, that's a good sign, right? Bullish.
Generally, yes. It suggests that the buyers are in control. But on the flip side, if the price breaks below the moving average and struggles to get back above its business, it could be a sign that the momentum is shifting.
So it's like a tug of war between the buyers and the sellers, and the moving average helps you see who's winning.
Precisely. And traders use different lengths of moving averages to confirm trends over different time frames. Some look at shorter-term moving averages like the 50-day or the 100-day, while others focus on longer-term ones like the 200-day.
So it's like having a whole team of analysts, each one giving you a different perspective on the market.
I like that analogy. Each moving average provides a different piece of the puzzle.
Now, before we move on, our source mentioned another tool for finding these levels. Fibonacci retracements, but they didn't really delve into it. What are those all about?
Fibonacci retracements now. Those are interesting. They're based on this sequence of numbers where each number is the sum of the two preceding ones. You start with 0 and 1, and then you get 2, 3, 5, 8, 13, and so on.
Okay, I vaguely remember this from math class, but how does that apply to the stock market?
Well, the ratios between those Fibonacci numbers, like 0.382, 0.50, 0.618, they tend to line up with significant support and resistance levels. It's kind of wild, actually.
So you're telling me the stock market is secretly speaking the language of math?
In a way, yes.
Yeah.
These Fibonacci ratios, they appear everywhere in nature, from seashells to galaxies, and for some reason they also show up in the financial markets.
Okay, my mind is officially blown. So let's say we've used all our tools, trend lines, round numbers, moving averages, maybe even a little Fibonacci magic, and we've identified some potential support and resistance zones. What happens next? What do we do with that information?
That's the million-dollar question, isn't it? The real excitement begins when the price actually approaches those levels. It's like watching a game of tennis. Will it bounce off that level or break through it?
So it's like those levels are the net and the price is the ball bouncing back and forth.
Exactly. Sometimes the price will hit support or resistance and bounce right off like a perfect volley.
Hmm.
Other times, it'll break through that level like a powerful serve and signal a potential trend change.
And how do we know if a breakout is the real deal or just a fake out?
That's where things get tricky. There's no foolproof answer, but our source highlights a few key things to look for.
Like what? Give me the inside scoop.
First, you have to consider the strength of that support or resistance level. Has the price touched that level multiple times before? Was the move leading up to it sharp and decisive, or more of a gradual drift? And perhaps most importantly, what's the volume like at that level?
So high volume, multiple touches, big price swings, those are all signs of a strong level.
Big toss. A level that has been tested and held strong multiple times is like a fortress much harder to break. But remember, even the strongest fortresses can be breached eventually. Nothing in the market is guaranteed.
So let's put ourselves in traders' shoes for a second. Imagine we're watching a stock approach a support level. It's bounced off a couple of times before. What are we looking for to decide if it's going to bounce again or if it's time to head for the hills?
Well, first things first, you have to zoom out and look at the bigger picture. What's the overall market sentiment? Are there any news or events that might be influencing this particular stock? Context is key.
Right, you got to look at the whole market story, not just one little piece of it.
Exactly.
Yeah.
And then once you've got that big picture, then you zoom in and look for those telltale signs like volume. Is it picking up as the price approaches that support level, or is it fading away?
High volume usually means there's a lot of interest, right?
Exactly. It suggests traders are really watching that level, which makes a bounce more likely.
Okay, so we're looking at the big picture. We're zooming in on volume. Any other secret weapons in your support and resistance arsenal?
You know, at the end of the day, a lot of it comes down to experience. The more charts you look at, the more you start to develop a feel for these patterns.
It's like anything else, the more you do it, the better you get at it.
Exactly. Your brain starts to pick up on those subtle clues that you might not even be consciously aware of.
So as we wrap up our depth dive into support and resistance, what are the 2 or 3 big takeaways you want our listeners to walk away with today?
Well, number one, I'd say don't be intimidated by price charts. I know they can seem confusing at first, but support and resistance levels, they act like guideposts. They help you make sense of all the chaos.
They give you a roadmap.
Precisely. And once you learn to spot those levels, you'll start seeing potential trading opportunities everywhere.
Okay, love that. What else?
Don't rely on just one tool or indicator. Use everything at your disposal. Trend lines, round numbers, moving averages, even a little Fibonacci if you're feeling adventurous.
The more data, the better.
Exactly. Each tool gives you a different piece of the puzzle. And finally, never underestimate the power of psychology.
Ooh, yes, the human element.
The market is driven by people, and people are emotional.
Yeah.
We make decisions based on fear, greed, hope, all sorts of things. And understanding those psychological factors is just as important as any technical indicator.
It's like you're not just trading stocks, you're trading human behavior. This has been amazing. So for everyone listening out there, next time you're looking at a price chart, whether it's your favorite stock or cryptocurrency or even the price of, I don't know, vintage sneakers online, see if you can spot those support and resistance levels. You might be surprised at what you find. And who knows, maybe you'll even be able to predict the market's next move. Thanks for diving deep with us today.